Hi everyone, and welcome to today's video. What we're going to talk about today is tax layering. And tax layering essentially means that we're going to look at our sample client, John Sample's income, and try to give him the best tax outcome. So, John's income is comprised rather of Canada Pension Plan, Old Age Security, and his pension income from the City of Toronto. The objective here, as I stated, is to give him the best tax results. So we're going to look at his fixed income sources and his variable income sources, and we're going to try to give him the best tax outcome. His income breaks down as follows: Canada Pension Plan, $12,843; Old Age Security, $83.92; Toronto Pension, $20,000 for a total of $41,235. His annual income needs, $70,000 is what he's decided he needs to maintain his lifestyle. We deduct from that his known income sources, and we're left with a shortfall of $28,765. We have to make that up from his investment accounts, including his registered savings plan, his tax-free savings account, and his non-registered investments. $250,000 in his RRSP, $150,000 in his tax-free savings account, and $75,000 in his non-registered investment account. Let's flip over now to his registered assets calculator. And the first thing we're going to do is we're going to determine what income he can maintain from his registered assets if we look at his current balance and try to give him an average over his lifetime. So we're going to assume that he wants to take income from his RRSP until the age of 90. The best tax outcome would be to average that out. And so we've done that. And if we look at the result, you can see at the age of 90, he's left with just $59 in his RRSP. And in order for us to do that, he's going to take $12,500 a year from his RRSP. We move on to his tax-free savings account. Here, we're not going to take income. All we're going to do is grow it over time. We're going to do the same thing with his non-registered assets. You can see from age 66 to age 100, and we're going to grow it at 4%. And we'll talk about why we're not going to take money from there in a second. Flip over to the layering calculator, and we're going to take a look here, and we're going to see that his income needs again are $70,000. That puts him at a marginal tax rate of 34.65%. His fixed income, again, Canada Pension Plan, Old Age Security, and his City of Toronto pension. Okay, and those three alone put him at a 29.65% marginal tax rate. But we are short. We are short $16,265. You can see if we flip over to the side here at registered income, we have included the $12,500 from his RRSP, but nothing else. So we're going to have to make up the difference from his remaining variable assets. You see, if I simply take the money from his RRSP, we have the $70,000, but our marginal tax rate is 34.65%. We're going to pay taxes of $11,448 on that total income. Let's look at another variation of the income. We're going to go back to the $12,500 only from the RRSP. That puts us back down to $53,735 and short the $16,265. But you can see our taxable income has now dropped to 29.65% in terms of marginal tax rate. So instead of taking that money from the registered income, we're only going to take the amount that we need to get him to the top of his current marginal tax rate. So we're going to take everything we can at that 29.65% rate. That's called topping to bracket. Okay, and then the difference is going to come from either his non-registered or his tax-free. In this case, I'm going to show it from his tax-free. We go back here and we can see now that we are at $70,000. We've achieved total income of $70,000. But our taxable income is only $55,866. We've saved 5 percentage points in terms of the marginal tax rate. And if we flip over to the side and look at his taxes payable, you recall it was just over $11,000. The total tax now is just over $8,000. We've saved about $3,000 in taxes by layering his income with some purpose. There is just a couple more things to do. We're going to flip over to our registered tax calculator. We're going to show the lump sum that we are taking out in order to make sure that we have that accounted for. And then we're going to flip back to our layering calculator. We're going to see what we took from his tax-free savings account. Flip over to our tax-free savings calculator, and we're going to show that lump sum redemption as well, so that we have a proper accounting of our redemptions for the year, and we can track our progress. And that is the way the layering tax calculator works. Folks, if you want to learn more, talk about your own situation, please reach out to me, and I look forward to speaking to you. Thank you.